Setting and monitoring a cash budget. Holly owns a copy shop, but has trouble managing her cash flow and growing her business. Last month, she bought 2 new copiers to meet demand, but now she doesn't have money to cover the rent. This can happen to any business, even those that turn a healthy profit. For example, your business could run out of cash if some customers don't pay their accounts on time. Or if you take advantage of a promotional offer from a supplier and buy too many materials. You can use cash flow projections or a cash budget to make sure that your business always has enough cash. In this lesson, you will learn: what are the benefits of cash flow projections for managing business growth? How to manage a cash flow projection for implementing your growth plan during the first year. How to get the most from a cash flow projection. Benefits of cash flow projections. While the cash flow statement is a summary of cash entering and leaving your business over a period of time in the past, a cash flow projection is a forecast of how much cash you expect to come into and go out of your business in the future. A cash flow projection enables you to predict when cash shortfalls are likely to occur so that you can take action to avoid them. As a result, you'll be able to build better relationships with your suppliers and receive better payment terms. You can also use a cash flow projection to help prevent business interruptions. It can help you decide when to invest idle cash reserves in short-term notes or even stocks to increase your business's income. Sound cash flow makes a company attractive to lenders. Your bank will always request a detailed cash flow forecast before they consider loaning any money. Growing businesses are often hungry for cash. You have to invest much more than other companies do, and profits usually won't be enough to cover your investments. Therefore, having a cash flow projection is essential. How to create a cash flow projection. Depending on the needs of your business, you can decide how far in advance to forecast your cash flow. It can be done every quarter, 6 months, or annually. A cash flow projection is normally divided into months. To make a cash flow projection, you need to know how much cash will come into your business each month, and how much cash will go out of your business each month. The majority of cash coming into your business is from sales. Remember, you made your monthly sales forecast in week 2. If your business does not allow sales on credit, all your sales revenue will be cash sales. So, just copy the figures for total forecasted sales and you'll have your projected cash inflows from sales. If you do sell on credit, the cash you receive will be different from your sales figures. You'll need to estimate the portion of cash sales in your total forecasted sales. Examine your past records to get a benchmark of cash sales as a percentage of total revenue each month. You should also look at your sales plan for the coming year to see if any of your new strategies may increase or reduce your cash sales percentage. Use this information together with your sales forecast to estimate the amount of cash your business will actually receive from sales each month next year. Credit sales equal your accounts receivable and will be turned into cash after a certain time. So, in addition to cash sales, receivables collection represents another stream of cash coming into your business. To estimate how much your credit customers will pay each month, review the payment terms you've established with your credit customers. Cash comes into your business not just from sales, but from other sources as well, including loans, interest on savings, income from investments, and owners' capital contributions. Forecast the amount of cash your business will receive from sources other than sales each month next year. Add up the various types of cash inflows to see the total amount you expect to come into your business for a given month. Let's take a break and check what you've learned. How to create a cash flow projection, Part 2. The majority of cash going out of your business funds operations. This includes the cost of making products or providing services and overhead expenses. In week 2, you created your operation and cost plan. Now you can use your forecast of costs to estimate the cash outflows for next year. But don't just copy and paste, because the date you make a payment is not always the same as the date you incur the actual cost. You may pay some costs in advance and some afterwards. To estimate how much cash your business will actually spend on operating costs each month, first, forecast the amount of cash your business will pay out for raw materials each month. Next, estimate the amount of cash your business expects to pay out for wages each month. Then, estimate the amount of cash to be spent on overhead expenses. With some overhead expenses, like licensing fees or insurance, you may just make one payment per year, so cash out for overheads often differs from overhead expenses. Add up the estimated monthly cash out for materials, labour and overhead expenses. The total is the projected cash outflow for operating costs each month. When forecasting future cash outflow, aim to be comprehensive. The more detail, the better. You may also plan to buy new equipment or make other investments. Determine the amounts you want to invest and the months when you will actually pay for the investments, and add these to your forecast. In addition to cash outflow for operating costs and investments, your business also has other cash outflows, such as loan repayments, tax payments, and owners' withdrawals. Remember to include these cash outflows in your forecast. Add up the various types of cash outflows to see the total amount you expect to flow out of your business in a given month. Now that you've estimated your cash inflows and outflows, use them to develop your cash flow projection. First, enter the amount of cash your business has at the start of the forecasted period, or start of the year. This is the amount of cash on hand plus the cash in your bank account at the end of the last period or end of the year. Next, fill in your cash flow projection with all the estimates you've made. Subtract the total cash out each month from the total cash in for that month to determine the net cash inflow/outflow. A negative figure means that your business will spend more cash than it can generate. In other words, your business will have to use its cash reserves to pay for daily operations. Determine the cash balance for the end of the first month by adding the cash your business had at the start of the month to the net cash inflow or outflow during the first month. Apply the same procedures for the following months. Fill in cash at the start of each month using the cash balance from the end of the previous month. Calculate the net cash inflow or outflow and determine the projected cash balance at the end of the month. Now let's check what you've learned. How to use cash flow projections, Part 3. Now you have a cash flow projection on hand. But what if your business's cash balance at the end of a month is projected to be negative? A negative figure means your business will run out of cash that month, and this requires action now. Think of different ways to solve the problem. Remember actions you can take to improve cash flow from the previous lesson. For example, follow up with your credit customers to make sure they'll pay on time. Negotiate with your suppliers for a longer credit term. Sell unnecessary assets, cut costs, or increase savings. Postpone a purchase. If your future cash flow is still not projected to be enough, consider adding cash from outside sources. There are plenty of ways to solve a cash shortfall problem. When considering each option, determine whether the solution would affect your sales forecast or operational plan. You may need to go back and adjust your sales forecast as well as your operational and cost plan. Then update your cash flow projections to reflect the changes. On the other hand, if your cash flow projections show that you'll have a large cash balance at the end of several months, consider depositing surplus money in a savings account or investing it to earn interest income. If you decide to put excess money in a savings account, be sure to make adjustments to your cash flow projections too. Check your cash flow projection after each adjustment to see how it looks. Continue to improve your cash flow projection until it looks good to you. The goal is to strike a cash reserve balance that is neither too much nor too little, but still allows your business to pay its daily operating expenses. This way, you'll always have enough money to run your business. Sometimes actual sales may not turn out to be as much as you had forecasted, or some customers may pay you late. Aim to maintain an adequate cash balance for these situations. Once you've forecasted the ebb and flow of cash for your business, you can use this information in a variety of ways. For example, estimate your financing needs. Determine the amount of cash your business requires to finance its growth next year and when you'll need it. We'll learn more about this in the next lesson. Monitor your performance. Compare your actual figures with your cash projections and make adjustments to your projections as you go. Now you should have a clearer sense of how to use a cash flow projection. Let's check what you've learned. Summary, Part 4. You've just learned the benefits of cash flow projections, how to make one, and how to use it. Now you can feel more confident implementing your growth plan. Look at your sales forecast and your operational and cost plan, as well as your business's record books. Make a cash flow projection for your business next year. You may want to ask your accountant to assist you. Then spend a few minutes filling in the next section of your growth plan.